Welcome to the Deep Dive. Today, we are plunging headfirst into the latest from UiPath.
The automation folks.
Exactly.
Yeah.
You know, there's so much buzz around AI, automation. Everyone wants to know how it actually translates into, well, business results for the companies building the tech.
Yeah, that's the key question, isn't it? So for this deep dive, we've gone through the earnings call, transcript, the materials, all of it.
And the mission.
The mission is to cut through the jargon, basically, give you the really important insights from their first quarter fiscal 26 call, how they did financially, what their big strategic moves are, especially with AI, and, what the outlook tells us about where they're headed.
Get people informed straight from the source.
Exactly. No fluff.
Okay, let's do it. So the numbers. How did Q1 fiscal 26 look for them?
Well, on the surface, pretty solid. Generally came in ahead of what people were expecting. Revenue was $357 million.
And for a company like UiPath, that subscription model means ARR is king, right? Annualized recurring revenue.
Definitely. That's the one to watch. They finished the quarter at $1.69 billion in ARR.
Okay, $1.69 billion. How is the growth looking year over year?
ARR grew 12% compared to last year. And looking at profitability, there was some really significant movement there.
Improvement, you mean?
Yeah, big improvement. Their GAAP operating loss, it narrowed a lot, down to just $16 million. Last year, same quarter, it was a $49 million loss.
Wow, okay. That's a big swing. What about non-GAAP?
Even better on a non-GAAP basis, they actually had operating income of $70 million. That works out to a pretty healthy 20% margin.
20% margin, and that's up from last year too?
Yep, 450 basis points better. So like 4.5 percentage points higher margin.
That really does show some, operational leverage kicking in, getting more efficient.
Right. They're getting more profit out of their existing setup.
And cash flow. Did that follow suit?
Cash flow is strong too. Non-GAAP adjusted free cash flow came in at $17 million. That's a 33% margin on that figure.
33%. Nice. And the balance sheet overall?
Still looking very robust. They ended the quarter with about $1.6 billion in cash and equivalents. And importantly, no debt.
No debt is always good to see. Were they buying back shares?
They were. Continued the buyback program, repurchased about 21.9 million shares during the quarter. Average price was around $10.40.
Okay, so the financials paint a picture of, solid execution, improved efficiency, managing the current climate pretty well.
I think that's fair.
But listening to the call, it really felt like management was hammering home something bigger. A major strategic push or maybe an acceleration. What was that main theme?
Oh, absolutely. You picked up on the main event. While the numbers are, important context, the overwhelming focus, the real energy on the call was all about their push into what they're calling agentic automation.
Agentic automation.
Yeah, that includes their agentic automation features and this orchestration layer they've named Maestro. And then you just mentioned it. They framed it as like one of the most significant product things they've ever done.
One of the most significant ever. Okay, that's a strong statement. So agentic automation, it sounds like AI, obviously, but how did they explain what it actually is?
Yeah.
And why do they think they're the ones positioned to win here?
Good question. Because, the term itself can sound a bit fuzzy. So think about traditional RPA, robotic process automation.
Right, the bots following scripts.
Exactly, like a very precise recipe. Step 1, step 2, step 3. It's deterministic. The bot does exactly what it's told based on fixed rules every single time.
Okay.
Agentic automation, which uses AI, is more like, empowering an assistant. Someone who can follow the recipe, sure, but can also make judgments, adapt if something changes, maybe even figure out the best next step based on the situation. It's probabilistic.
So less rigid, more adaptive, using AI to make decisions when things aren't perfectly predictable.
Precisely. And Maestro, that's the orchestration layer. Imagine it like the conductor of an orchestra, making sure all the different players, whether it's the old style RPA bots or these new AI agents, are working together smoothly, doing the right task at the right time across maybe a really complex business process.
Ah, the conductor. Got it. So Maestro pulls it all together. It's about combining that reliable, rules-based stuff with these smarter, adaptive AI actions.
That's the idea, blending the deterministic and the probabilistic.
And they must think their history, their current position, gives them an edge in doing this.
They strongly believe they have a right to win, as they put it. They laid out 5 key reasons why their platform is, uniquely suited for this moment. It's not just one thing, but how they all fit together.
Okay, let's unpack those 5 reasons. What gives them this confidence?
All right. First, they point straight at their huge installed base. Over 10,000 customers already using their automation platform.
Right, they're already inside these companies.
Exactly. They have robots embedded in real enterprise processes. This gives them, they argue, unmatched insight into where automation is already happening, what tasks are being done. It's a natural starting point to then add these intelligent agents into the mix.
So footprint and process knowledge. Advantage one, what's number two?
Second, they really emphasize their unique ability to bridge that gap between the older deterministic RPA and this new probabilistic agentic stuff. Most companies, realistically, are going to need both, right?
Yeah, you can't just flip a switch usually.
Right. UiPath's platform lets customers integrate them seamlessly. So you can extend automation into much more complex adaptive workflows than you ever could with just RPA alone.
Yeah.
It's about building on what's there, not just ripping and replacing.
Okay, blend old and new. Makes sense for big companies. Third point.
Third, they stress their vendor-agnostic architecture. This is, well, it's huge in the AI space right now. Things are moving so fast.
Models changing all the time.
Exactly. Their platform can plug into basically any underlying AI model or agent framework. Google's, Microsoft's, OpenAI's, whoever. That gives enterprises flexibility, avoids locking them into one vendor's AI. That's crucial.
Flexibility is definitely key.
Yeah.
Okay, number four.
Fourth is the enterprise-grade foundation. Look, for big organizations to actually deploy AI agents widely, it has to be secure, compliant, and have strong governance controls.
Non-negotiable for serious businesses.
Totally. Their platform provides that trust layer. Things like human-in-the-loop workflows, where a person needs to check or approve what an AI agent suggests or does, especially critical for sensitive stuff.
Trust and governance, absolutely vital hurdles for enterprise AI. And the last one. Number five.
Finally, it's their unified end-to-end platform. It's not just a bag of separate tools. It's one integrated platform for the whole lifecycle. Finding automation opportunities, building bots and agents, deploying them, managing them, governing them, all in one place.
Simplifies things, presumably. Gives confidence for scaling up.
That's the argument. Makes it easier to manage and scale across the whole organization.
Okay, so the pitch is leverage the install base and process knowledge, uniquely bridge RPA and AI agents, stay flexible with open architecture, provide enterprise security and governance, and offer it all in one platform. That's, well, it's a compelling vision. But is it just a vision right now, or are they actually seeing traction? Is this agentic platform being used yet?
Management sounded really encouraged by the early signs. They described it as accelerating adoption. Since they launched their agent builder tool in preview, that was back in January, customers have already created, get this, thousands of these autonomous agents.
Thousands already.
Yeah. And those agents have performed over 250,000 runs. The orchestration piece, Maestro, which went into preview in March, has already powered over 11,000 process instances. These are early numbers, sure, but it shows real usage is happening.
Thousands of agents, hundreds of thousands of runs, thousands of process instances, just in a few months of preview. That does sound like pretty solid engagement right out of the gate. How are they planning to make money from this? Is it the same pricing?
No, this is a key shift. They've brought in a new consumption-based pricing model specifically for these new agentic capabilities.
Pay as you go, essentially.
Kind of. Instead of just a fixed subscription per robot or per user, customers will pay based on how much they actually use these new capabilities, the agent runs, the orchestrations via Maestro, and the value they get.
Aligning cost with usage and value?
Exactly. The idea is to encourage adoption and make the pricing reflect the benefit received. It's a pretty significant change.
Makes sense.
Hey.
So let's make this real. Did they share specific customer stories on the call? Examples that show how this platform is actually delivering value?
They shared quite a few, actually. One that really jumped out was a Fortune 5 global health company.
Fortune 5. Okay, that's big.
Yeah, not a small pilot. They signed a multi-year, multi-million-dollar expansion deal specifically to adopt Maestro and Agent Builder at scale. They're weaving these agents into really complex workflows, needing that enterprise governance and human oversight we talked about. That's a massive commitment so early on.
A Fortune 5 company betting big on this platform right away, that is a strong signal. Any other interesting uses they mentioned?
Yeah, there was a leading global apparel retailer using Maestro. They're using it to orchestrate a whole end-to-end process for handling user queries with what they called a master support agent.
So Maestro is the conductor again.
Exactly. Pulling together robots, AI agents, different back-end systems, automating everything from routing the query to generating support tickets, helping get it resolved. Shows how orchestration connects the dots.
Okay. Any others? Maybe a competitive situation?
Definitely. They talked about a global healthcare technology company. This was a competitive displacement. They chose UiPath, consolidated onto their platform. They're integrating the new agents, Autopilot.
Autopilot, that's their AI system for users,
Okay.
right?
Yeah, embedded in workflows helps people complete tasks faster. So they're combining agents, autopilot, and traditional RPA for things like sales order processing. And they expect this combo to cut processing time by about 25%.
25% time reduction. And winning that deal against a competitor suggests this new agentic capability isn't just for existing customers, it's helping them win new business too.
Management made that exact point. They believe being able to handle both the deterministic RPA and the probabilistic agents on one platform is a key differentiator against competitors. They cited another competitive win, too, Continental Resources, adopting their agentic testing solutions.
Agentic testing, interesting.
And a global financial and mobility services provider. They're scaling Autopilot, that AI assistant, to over 5,000 employees for claims management. That's after a pilot showed really significant time savings.
5,000 employees using Autopilot. Okay, so clearly the agentic push is central, but what about the rest of the platform? Are other areas still getting attention, seeing progress?
Oh, yeah, absolutely. They didn't forget the rest. They highlighted their leadership in intelligent document processing, IDP, got recognized again by Everest Group, and they've released a next-gen version called Intelligent Extraction Processing, or IXT.
My XP, what's different there?
It's designed for really complex, unstructured stuff. Think messy scanned documents, faxes where information isn't in nice, neat boxes. Hub International, the insurance broker, is using IXP to pull data from all sorts of carrier files.
Okay, handling the tough documents.
Yeah.
And Autopilot seems to be getting traction too.
Yeah, as we mentioned with that financial services example, they reported significant sequential growth in monthly engaged users and the number of actions taken via Autopilot. So it's growing.
All right, moving beyond their own tech partnerships, how critical are those, especially with the big AI players, for making this whole strategy work at scale?
Oh, absolutely central, crucial. They announced a big strategic AI partnership with Google Cloud,
Google.
focusing first on healthcare. They're building an AI agent for medical record summarization using Google's Vertex AI and Gemini models, but it runs on the UiPath platform. The potential impact. They estimate it could cut prior authorization times, which can be a huge bottleneck, by up to 50%.
50% reduction in prior auth time.
Yeah.
In healthcare, that's massive, huge potential impact.
Yeah, really significant if they can deliver that consistently.
What other key partnerships are they leaning on?
Well, they also highlighted the ongoing strategic work with Deloitte. This was interesting. Deloitte actually used UiPath's platform for their own huge internal SAP S4 HAM migration.
They used it themselves.
Yeah, automated nearly 60% of their test cases. Now they're taking that playbook, this automation-first agentic ERP approach, and replicating it with joint customers, like a Fortune 20 oil and gas company aiming for similar big reductions in manual testing.
Using their own internal success story as a sales tool.
Smart. Very smart. And on the tech side, they deepen their ties with Microsoft. Now there's bi-directional integration with Microsoft Copilot Studio, meaning you could potentially trigger UiPath automations or agents from within Copilot, and maybe vice versa. Connects the ecosystems. They also partnered with LangChain.
The popular AI developer framework.
Right. So developers using LangChain can now deploy the agents they build onto UiPath's secure, governed enterprise platform. It's all about building out that ecosystem, both strategically and technically.
Okay, let's quickly touch on the public sector. Often a big opportunity, but sometimes tricky timing. What's the latest there?
They sounded pretty optimistic about progress in the U.S. federal market, stressed they're committed to helping customers through the ongoing transition period there. They specifically called out the Air Force's Agentic Airmen initiative.
Agentic Airmen.
Yeah, sounds cool, right? The idea is integrating agents and AI for a broad transformation, potentially impacting tens of thousands of personnel. So big ambitions.
There's usually a but with federal.
But yeah, they also acknowledge the reality of government budget cycles, things getting finalized. So while they're encouraged long-term, they're baking some prudence into their near-term guidance for federal, recognizing that the transition is still playing out and can affect when deals actually close.
So belief in the long run, but caution near-term in the numbers.
Got it.
Yeah.
Earlier, you mentioned the operational transformation they've been through. How's that going? Is it done? What's the impact?
Management said it's substantially complete now, and the benefit is what we saw in the Q1 numbers that improved operating leverage, better margins. They noted their go-to-market teams are stable, performing well.
So the focus shifts now.
Yeah, focus now is on investing smartly, especially backing that agentic momentum we've been talking about.
Oh.
And interestingly, using their own platform internally to find more efficiencies for themselves, eating their own dog food, so to speak.
Always good practice. Okay, that brings us nicely to the investor angle and the outlook. We talked ARR growth overall. How did that break down? New customers versus getting more from existing ones. So net new ARR added in Q1 was $27 million. They said they're really prioritizing signing those big new enterprise logos, the ones that fit the profile for long-term strategic automation partnerships. They mentioned names like McLaren Health, Paylocity, Norwegian Cruise Line, and a competitive win displacing Delta Airlines at one company.
Okay, so focusing on quality additions, how many customers overall?
Ended the quarter around 10,750 customers. They did note that most of the churn, customers leaving, is happening at the smaller end of their base. But crucially, the growth in their biggest customer groups was solid.
The $100K plus and $1 M plus ARR customers.
Exactly. Customers spending over $100K a year grew 13% year over year. And those spending over $1 million a year also increased. So the big customers are growing.
And retention. How well are they keeping and expanding the customers they have?
Their dollar-based gross retention, just measuring how much revenue they keep, ignoring expansion, stayed strong at 97%. The dollar-based net retention rate, which includes expansion, was 108% in Q1.
108%. Still expanding overall, but maybe a bit lower than peak pandemic times.
Right. Management pointed to a few things putting pressure on that expansion piece. The variable macro environment, that federal transition timing we discussed, and just some Q1 specific deal dynamics. But
they see potential for it to stabilize.
Yeah, they think it could stabilize as these new agentic platform capabilities really scale up and start driving new use cases and therefore new spending from existing customers.
Okay, that makes sense. Customers are still spending more overall, just maybe the rate of increase is moderated a bit with the economy. So let's look ahead. The guidance they gave for the full fiscal year 2026. What are the numbers?
Right. Full fiscal year 26 guidance. Revenue expected between $1.549 billion and $1.554 billion. ARR projected to land somewhere between $1.820 billion and $1.825 billion by year end.
And profitability.
On the profit side, they guided for about $35 million in non-GAAP operating income for the full year and pretty strong adjusted free cash flow, around $370 million. They also gave specific Q2 guidance, too.
Okay. Now, the big question. With all this excitement, all this talk about agentic automation, how much of that is actually baked into this year's revenue forecast?
This is really critical for setting expectations. Management was very clear on this. They explicitly called fiscal year 2026 a foundational year for agentic automation.
Foundational year, meaning?
Meaning, while they're seeing great early traction, thousands of agents, pilots kicking off, they do not expect a material revenue contribution specifically from these new agentic solutions in this fiscal year, FY26.
Ah, okay. So the big revenue impact from agentic is further out.
That's the message. They anticipate the really meaningful new revenue streams from agentic scaling up will start hitting in fiscal year 2027 and beyond.
Okay. So the agentic story is absolutely the future growth engine, the big bet. But the guidance for this current year is driven more by the core platform, traditional expansion, and obviously influenced by that macro environment keep mentioning.
Exactly right. They reiterated the macro environment is still variable and said their guidance reflects a prudent, cautious approach because of that. They did mention something about timing, though.
Oh.
Yeah, they noted a favorable timing and mix of deals they expect between Q2 and Q3, which influences how revenue might flow through the year. But despite the caution, they sounded pretty positive about their sales pipeline quality.
Pipeline quality is good.
Yeah, they described it as being boosted both by all this exploration of agentic use cases and just general new commercial activity. So pipeline looks healthy, potentially setting up future quarters, even with the prudent near-term guide.
Interesting mix. Good pipeline, cautious guidance reflecting the macro and the agentic ramp timeline. Okay, so stepping back, for you, the listener, what are the key things to really take away from this whole deep dive into the UiPath call?
Right. I think first you should understand UiPath put up a financially solid quarter, showed real improvement in operational efficiency. That's clear.
Okay, execution check.
Second, you should see a company making a very aggressive, very clear strategic bet on agentic automation as the future. They believe they can lead here by leveraging their base and uniquely combining the old RPA with new AI agents on an enterprise-ready platform.
The big strategic pivot.
Exactly. And third, you should definitely recognize that while the early adoption signals, the cusp of a buzz around agentic seems real and promising. The major financial impact, the big revenue dollars from this new wave, that's expected to be more of an FY27 story and beyond.
Right, which is why the guidance for this year is more cautious, even though the pipeline commentary sounded positive.
Precisely. It's that classic balancing act for a tech company, isn't it? Execute well now, manage costs, while investing heavily and strategically to capture what they see as a huge future market opportunity driven by AI.
Makes sense. All right, let's shift gears for our final segment. And as always, this part comes with a very, very clear disclaimer. Non-negotiable.
You know it. Let me say it loud and clear. This is not financial advice. Seriously. This next bit is purely for informational, maybe entertainment purposes, based only on the commentary from the earnings call we just discussed. Do your own research, understand the risks, talk to a qualified financial professional, please.
Couldn't have said it better. With that very important warning firmly in place, let's brainstorm. Based purely on the themes from the call, that heavy focus on agentic automation as a differentiator, maybe displacing older tech, what's one potentially outrageous but plausible trade idea that comes to mind?
Okay, all right. Leaning hard into that narrative, right? The story that their integrated agentic platform with Maestro conducting the orchestra is going to be the standard for enterprise automation 2.0, and that it lets them push out legacy players who maybe can't bridge that RPA to AI gap as well.
Yeah, I think I see where this might be headed.
Well, an outrageous but plausible thesis could be something like this. You take a long position in UiPath, you're betting their platform really does capture this next wave, this integrated AI-powered automation spend in big companies, becoming that go-to orchestration layer for, well, everything automation.
Okay, the long side makes sense based on their pitch. What makes it outrageous? The pairing.
Exactly. To make it spicy, you pair that long UiPath position with a targeted short position, specifically shorting a legacy automation vendor or maybe even a workflow software provider that seems most vulnerable based on the commentary, someone who might get displaced by this more adaptive, integrated approach UiPath is pushing.
So you need to identify a specific company that seems like it fits that vulnerable legacy description based on UiPath's competitive positioning comments or maybe industry chatter following the call.
Right. The core idea, the bet, is that as enterprises really start rolling out complex, AI-driven workflows orchestrated by platforms like UiPath's over the next, say, 18-24 months, they'll consolidate, they'll move away from vendors offering maybe less integrated, less flexible, less AI-ready solutions.
So it's a pure bet on that architectural shift driven by AI. Platform wins over point solutions or less integrated suites. New tech displaces old, high conviction on the agentic thesis, paired with a specific bet against a perceived loser in that shift. Again, folks, not financial advice, just exploring ideas based only on the call content.
Precisely. And understand, any trade like that carries significant risk. Lots of ways it could go wrong.
Absolutely. Okay, so let's quickly recap the main highlights from this deep dive then. UiPath, solid Q1, showing strong operational leverage.
Check. Their absolute strategic focus. Leading the charge into agentic automation with their platform, Maestro orchestration, seeing promising early adoption signs.
Check. Partnerships are key, especially with cloud and AI players.
But the big revenue impact from this new agentic wave, that's largely expected to be an FY27 story and beyond, which is reflected in their prudent guidance for this current fiscal year, even with positive pipeline signals.
Check. It's a picture of current execution funding, that big strategic leap into the future of AI-driven automation.
Well put.
Which leaves us with a final thought-provoking question for you, the listener, to chew on. Given the very real customer excitement and those adoption metrics for agentic automation they talked about, yet the cautious guidance suggesting material revenue is still maybe a year plus away. How quickly can these large enterprises really move? How fast can they go beyond the pilots, the early rollouts, to truly unlock that massive revenue potential management clearly sees in these powerful new AI capabilities at enterprise scale?
Yeah, that pace of adoption in big companies, it's always the million-dollar, maybe billion-dollar question, isn't it?
It really is the ultimate wild card. We definitely encourage you to dig into the materials yourself, armed with the insights we've unpacked today. Thanks for joining us for this deep dive.